South African Reserve Bank Governor Lesetja Kganyago is set to announce the first interest rate decision for the year. But economists are warning that while expectations are for the SARB to cut by 25 basis points, fingers crossed, new geopolitical threats could change its stance sooner than expected. Let's listen in to our business reporter, Ntokozo Khumalo.
The South African Reserve Bank is presented with a tight balancing act when it comes to deciding to cut or hike interest rates this year. Domestically, things are looking up with consumer pressures, including inflation, having eased.
We're not out of the woods. That's crucially important to remember. But I think 2025 is shaping up to be a little bit better than 2024.
However, new geopolitical threats are looming that could see rate cuts halted mid-year, according to Old Mutual's Group Chief Economist Johan Als, including U.S. President Donald Trump's stance on trade tariff policy that could impact the number of rate cuts South Africans enjoy.
It will depend on the data, and if they're too concerned, they will not cut in March rather than start to hike later this year.
Despite this, Als still expects at least 2 interest rate cuts this year, 25 basis points in the SARB's first decision announcement this week, and another in March. Standard Bank's Tabane Ndwandwe shares these sentiments, adding that even 2 cuts this year would make a huge difference for consumers in the long run.
What our view is, we still believe that we're going to get 25 basis points this week, tomorrow, and we think potentially another 25 basis points in March. So 50 basis points in a year for consumers who have mortgages equates to about 4 billion rands of installment savings for the whole year. So there's a lot of things that 50 basis points will do for the system in improving just consumer positions, consumer spend, etc.
However, this requires consumers to play their cards right, especially those with high levels of debt. National Debt Advisor's compliance manager, Dehan Sherman, says consumers have learned some hard lessons over the past 2 years in a high interest rate environment and should continue to closely manage their finances, even if it seems they have a little more disposable income in hand.
That requires self-discipline. It requires people to keep themselves in check, to manage themselves, to manage their spending and their standard of living. Otherwise, they're going to dig that hole for themselves and they're not going to get out of it.
He encourages consumers to be more in tune with the economic cycles to know how to best position themselves whether interest rates go up or down.
The key here is to pay attention to the economic cycle that you're in and adjust the way that you live accordingly. So, for example, in times where interest rates are spiking, that is where you should have put as much money away as possible to take advantage of the increased interest rates. When interest rates go down, that is where you service all your debt as quickly as possible. You service it as quickly as possible.
All eyes are now on the U.S. Fed that is concluding its 2-day meeting to give an idea of the direction the SARB is likely to take this year. In 2024, the Reserve Bank maintained its hawkish stance as it grappled with inflationary pressures, load shedding, and geopolitical tensions, including the Russia-Ukraine war. For Newzroom Afrika on Channel 405, I'm Ntokozo Khumalo in Johannesburg.